All right, good morning. Let me get my tea. BRB, just got to get some tea. Hang on. BRB, need some tea. All right, how you doing? Guten Morgen. Guten Morgen. Ja. I had to drink my kale. No, that's not my tea. That's my tea. Anyways, guten Morgen. Let's get on to going. Yeah. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. Gather here today to conduct technical and fundamental analysis, the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Good morning, Pip Pirates. Arr. Oh, look at my mess back there. Look at that mess. What a mess. I should clean that up. All right. How we doing? Looking good? Look how big my suits are. I've lost so much weight in the last year. Like, nothing fits me anymore. So anyways, hey, we got an interesting week ahead. We got some GDP. We got some PCE. It's a big deal. I'm telling you, this is a big deal. This is a big week. The week after the Fed meeting, we got a potential change in direction on seasonality. We don't know if that's actually true or not. It seems to me like many traders were anticipating that the Fed was done raising interest rates, and then they found out the Fed was not done raising interest rates. So now everybody's freaking out and buying dollar, and I'm like, yeah, you should have already known that they were not done raising interest rates. So anyways, so let people freak out. They freaked out the second half of last week, and then this week I'll allow them all 5 days to continue freaking out if they want. But I am still a bull in the market, so we'll see if I can be patient and disciplined enough to survive. My number one goal is to survive. So anyways, what are we going to do here? Well, today I think we should just catch up and find out where we are in the markets and where support and resistance is, and I can answer your questions. And we'll call that a wonderful day. It's a beautiful day. And for those who are YouTubers, which are many of you, I've uploaded a video to YouTube.com/quantbox. And I've uploaded a video to YouTube.com/tradeplans.ai. And so this is my third video of the morning. Remember this from Tarantino's, was it Inglourious Bastards? The British ordered 3 whiskeys. Yeah, anyways. Coolio. So we got to figure out our own puzzles. One thing I want to point out to you is on Wednesday, we are doing the fourth quarter outlook for 2023. We're going to go through dozens of economic charts and graphs and see where we are in the world of economics. Are things improving? Are things getting worse? Should we be risk on? Should we be risk off? And again, based on facts. So dozens of reports. Probably take us, what, an hour and a half? These meetings are usually about an hour and a half. So you can attend live. It's $10 though. It's $10. Okay, and you can attend live. It will be recorded. The recording will be accessible to you 7 days after the event. And then it's gone forever. Cool. That's this Wednesday, 2 days from now. 2 days from now. So let me pop that in there. Okay, that's good. Also like to point you to tradersway.com. An ECN. What does that mean? When you execute a trade, so you say buy or sell, an ECN immediately puts your trade into the interbanking system. Most brokers, or let's say many brokers, but most, use a different model where they trade against their clients. Traders Way is an ECN. They don't trade against their clients. So that's a simple distinction. Which one do you feel most comfortable with? Okay. So on the flip side of that, I believe they are trustworthy and ethical because of their business model. So I've been recommending Traders Way for, what, 8 years? You should check them out. Cool. Good. Good. All right. You're not the only one. All right. Staring at the sun. All right. Let's zip over and do some short-term indices. Okay. Swissy very weak, as expected. Pound continuing its weakness. Look at that. Just getting crushed. Let me update Swissy. Okay. Way outside of the comfort zone, which is lovely. Lovely to you, mum. Aussie kind of in the middle here. Euro right at the top end of the low falling trend. So maybe Euro weakens today. Kitty cat is just beautiful. I want to make sure these are all in the right time frame. I just noticed that's not on the right one. Okay. Nonetheless, hour. Yeah. Yen. Okay. Not weak, not strong. Ever so slightly strong on the short time frame. Change in yield curve control? No, not really. Change in seasonality? No, not really. Maybe this idea that they're going to jack up interest rates to 0. Yeah, but Uade didn't even address that at the last meeting, so you're like, no. So what's going on there? Oh, I don't know. It's just maybe exhausted. Or maybe it has to do with this dollar strength from the sudden and radical idea of, oh my God, the Fed has to raise interest rates more. And then I guess what might happen is we find out that it's one and done and higher for longer. Okay? One and done and higher longer. And so that's the next thing that could be creating dollar strength, is that investors were pricing in rate cuts next year. So let me make two comments. If you are a member of QuantBox, a subscriber to QuantBox, we know sort of the truth here. Well, the rate hike that surprised people, the next one that's being priced in, according to the Summary of Economic Projections. Okay, well, we already knew that. So this surprise is a bit surprising. The market is also trading as if the Fed has removed the rate cuts next year, but they didn't according to the dot plot. Now, I expect they will remove those. I don't think there's rate cuts coming to 2025, but now that's me talking. That's me having an opinion. Nobody cares. What we want to know is the facts. And so really nothing actually changed, except we got more certainty that the Fed's going to raise one more time and confirmed that next year there will be some cuts. So people have to, I don't know, either the Fed needs to change or the market is wrong. So whatever. Dollar is strong currently, and that's the way it's going to be until it changes. Okay, fine, great. But I think the strong dollar holds up the yen from weakening, because the strong dollar creates risk off. Now, my sort of bigger fear, if you will, let's say concern, is that this isn't actually, let's say pricing out the rate hikes next year. This has to do with yields on the long end of the curve dramatically rising. And continued rising. And that's sort of a new challenge to be running into. It's a newer one where just in the last couple of weeks, the yield is really just gotten crazy. And on the 10-year and the 30-year, and what could end up happening is we have a 5-year at 5 and a 10-year above 5. Now, we're only at 4.5, but wouldn't that be interesting if a 2-year is 5 and the 10-year goes to 5.5 and the 30-year goes to 6, and you get to a point where nobody's buying these bonds and treasuries. Well, let's say nobody's buying the treasuries. So like Saudi Arabia is not buying the treasuries. China's not buying the treasuries. So these yields go high, much higher than we've seen in a very long time. And then because of that, the cost of borrowing money by the government, but also, because you have to understand this will trickle down to corporate bonds, that sort of Russell 2000 and most S&P 500 type companies will struggle to get affordable capital. And that will mean they either don't expand, which is not good for an economy, because then the economy won't expand, or there's no profit for these businesses anymore. Because they might have, let's say, an 8% profit margin, but if their cost of capital goes up to 6 or 7 or 8%, then there's just no profit anymore. And that would be a problem for the financial markets like the stock market. Okay. So anyways, be interesting if it's, a structural shift. A very poor American foreign policy for decades maybe is finally come to fruition. Maybe. Who knows? So we'll have to keep our eye on the yield. Bitcoin says risk off, baby. I am expecting a risk off week followed by risk on. So I'm not going to be selling this week, but I will be interested in buying. Not necessarily Bitcoin, but in general. So I see Bitcoin down right now, and that makes sense. Will we be able to break a range here? Yeah, maybe actually. Nothing really to indicate it. But you can see earlier in September, I was looking for risk on. I'm just going to delay this and do it more like that. It's now, my September plan is now my October plan. I will leave natty. Looking at gold, what's going on in the gold market? I have to zoom in here. And nothing is going on in the gold market. So let me break this down because you're like, Wayne, there's so many lines. Well, first of all, every day we go over this. And so I'm assuming you understand the layers of the onion. But if you don't, that's okay. The current trend seems to be this way, okay? And therefore, I would say in the middle of this is the mean, and we're neither here nor there. It's not bullish because we made a low lower than this low. Okay? So if you wanted to be a bear on this, you could, for sure. You could do something like this and target 1907 if you wanted to. Okay. But there's ever so slightly uptrend going. PSAR looks at this time frame, which is the hour, and assumes you're long. So PSAR is saying probably want to target this way. But when you're in the middle of the range, 50-50, right? Oil tickled 90 and rallied up and then has given it back. So what do you want to do with oil? One of the things I noticed when reviewing the Commitment of Traders report, we have more bears now. There's more bulls on oil than a week ago, but there's more bears too. Interesting, right? So the way I look at it is some people are buying dips because they believe we're going to 100 and beyond, and bears are entering the market because they don't believe we're going to break 100. So more money has come in both ways. It's interesting, huh? So that's the Commitment of Traders report showing you that. So the market is becoming more neutral, or maybe that's the volatility coming in. Bulls buy dips, bears sell rallies. Bulls buy dips, bears sell rallies. Bulls buy dips, bears sell rallies. And you got that. So anyways, money moving toward it, it's becoming more and more challenging, I think. Okay. But what I saw earlier today was tickle this 90, which is about here. We did it on Friday as well. And somebody kind of popped it, but then now it's dropped back down. Cool. So we can put some more time on this. In fact, I'm going to change this to a different point of view. Let's do this from daily confluence. And yeah, that's much clearer. Okay. Bulls, you have to be quite concerned about that lower high. So if you were going to be a bear and you sold it up in here, I get you. I get you. Okay. So now the next move would be lower low, lower high, lower low. Okay. If it doesn't work, then we end up being in fib wars this way. Oops, that was supposed to be a straight line. It's a straight line if you're cross-eyed. Hey, Wayne, that's rude. My cousin's cross-eyed. I'm sorry. So like a breach, pullback kind of move. So big fella took it down at 91. Yeah, I get you. That makes sense to me. Mm-hmm. So that's WTI, that's gold. What session do I execute positions? Afternoons, I think most of them. But I'm like, I mean, look, the best times are market opens or market closes. Asia open. New York close, London close, New York open. But yeah, around the opens and closes. I want to point this one out. Let's not on a 5-minute chart though. Let me change this to daily confluence bearish. So I'm going to throw down a bias. And then I'll put this to a 4H. Okay. I did a whole video on that this morning at QuantBox. HTTP. Since you're asking me very specifically, fundamentally, youtube.com/@QuantBox. I believe that'll take you there. Let me see. Is that right? Yeah, here we go. So I did one this morning, right here. And I believe I had talked about that directly or indirectly. So that's the actual video. Okay. I did that 2 hours ago. What do you think? Too much? Does the purple go with the gray? Wasn't sure. Oh. Now I can't see it. It looked better. There we go. Does it go all right? Yeah? Like, makes me look old though, doesn't it? All right. Peso. Here's what I wanted to talk about. This is an interesting price here. Okay, if we wanted some down. Now, I expect dollar strength this week. I do. But I also expect money to move towards commodities. And if the dollar weakens next week, then like this and even Rand okay, could strengthen. Interesting. It could be interesting. So right now, this is a hope and a prayer, but this might be interesting throughout the week if it rolls over this way. Okay? You don't know? Maybe, right? So I'm going to look for that. But once again, I believe this is going to be up this week, and I'm hoping down next week. And so that's why I'm looking at this now. Maybe this is, maybe Mexican peso stays relatively strong as it has been for a while. So you're like, that looks weak, Wayne. No, this way, okay? So I understand we had this bottom, then we had the higher high, and now there's a higher low. So you technically would expect this, but fundamentally what I'm hoping for is that a reversion, okay? So who knows? I understand I'm grasping at straws and holding my breath and all that kind of stuff, but I'm not going to long this. So I can only set up shorts, and so that's why I'm throwing in that narrative. So really what I'm talking about is I'm setting up October trades now. So 1750 and then down, yeah, I'm okay with that. Yes, Akala, would you buy? Yeah, I mean, you just talked about, let's see. Let me go to QuantBox. Okay, by the way, there's a free training video in the description below to show you how to do it for free, right? But anyways, do I do fundamental analysis where you have a lot of economic indicators supporting it? Okay, let me show you like this. Okay, all right. Now this is a screenshot of old data, so this is like a year old, but check it out. How do I do my fundamental analysis? I compare between the euro and the dollar GDP growth and the change in growth. Is it a positive change or a negative change? I compare between euro and USD inflation and the change. Look at that. This is back when the United States had 8.5. I look at unemployment levels between Europe and the United States and the change. I look at interest rates between Europe and the United States and the change. And then I look at the divergence, aka the carry. Yeah, does that matter? Yeah. I look at the 20-year and the 5-year seasonality for the euro dollar, showing me, does it typically go up or down in January, February, March, April, May, June, July? Yeah. I look at, institutional positioning between the euro and the dollar. That's the Commitment of Traders report. But I like to just look at it here so I know that 76% are long dollar and 55% are short euro, obviously favoring a sell. I look at retail sentiment and they're heavily long, aka dumb money. So I want to trade against them. I put that and I score it. And I look at all these things and I score them and I rank them, including technical analysis. Here's the linear projection giving you worst case, base case, best case scenarios for shorting euro dollar with targets. Yeah. So the answer to your question is yeah. Now with QuantBox is just about a year old. Started about a year ago. And all I'm doing is automating all my research. Yeah. So here's another way of looking at it. Here's all the buys, here are all the sells, here's all the neutrals. And I think all the money lies in the neutrals because you're trying to figure out, will they go up in the future or go down in the future? And if you're ready, willing, and able before everybody else, you get on the new trend fairly early, especially when you correlate that with seasonality. So you want to look at, let's say, the neutral bunch, Marky Mark in the neutral bunch. Okay. And then you want to look at seasonality. Ha 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 ha. These ones typically start to turn bearish, and the green ones typically start to turn bullish. Cool. Okay, so back then, Quant Box, I would look at this and say, like Aussie and Kiwi yen back in this time frame, and I can tell by the other one. This was September of last year, and you would use QuantBox September of last year when I took that screenshot and assume up. So you look at now Aussie yen, September of last year. I'm going to have to go out to daily. It was right here. Is that right? No, it's this one. Nope, no, hang on. So in here, so you can see down, okay. So anywho, cool, man, cool beans. Cool beans. Okay. Dan, are you looking for something specific or like general? What kind of information are you looking for, Dan? And I can help out. Like over the weekend, I was on the OECD in the database, actually. OECD. And that might, right? Yeah. All right. So like you can go to OECD and you could probably just pull it up in here. I think they cover it here. I know it's a non-OECD, but cover a lot. China, there we go. Okay. Okay. Negative CPI, falling exports. Meat consumption, crop production, GDP. How's that? Crude production. M3. Interest rates. Is this helpful? They do forecasting, yeah. So at some point, though, you'll need to go right into the database. But yeah. So like when you go, so I was in the database yesterday, and let's see if I can do this for you. I'm not going to have time to do it. All right, so yeah, you can go into the database and pull out some projections. Well, let me just try it. Productivity, price, purchasing, is it general statistics, revisions, short-term economic indicators, economic projections. Oops. Oh, it's going to. I have to figure out how to get back. Okay, I started here, development, OECD, and then it was supposed to be non-OECD countries. Other projections. Anyways, the answer is yes, but you got to spend some time in the database. But this is what I was doing on Sunday afternoon. Okay. Yeah. There you go. Are you going to attend the Outlook on Wednesday, Dan? Hope to see you there. Yeah, catch the recording? All right. Why this month too ugly? I don't understand the question, Faber. We know the two, like I prepared you guys for the two most volatile weeks of the second half of the year. Third week of August, third week of September. So the third week of September is volatile. Now you might say ugly because it didn't go up. Okay, but it went down. But something's going to happen. And then we also know what normally happens. So, I don't know, patience and discipline, right? Patient. I'm patient. So if the market drops because a lot of people were either afraid or they were wrong in their analysis, that's fine by me because it will reset prices lower. And if what normally happens, then I will enter at a lower price. So in the Quant Box video, I go over how nothing's changed for me except I get a lower price. So this is typically, if last week was bad, this week is bad. Next week and the week after, I'm looking for good. So ugly, I would call it more like disappointing, but not ugly. Disappointing. But the bigger concerns I have is not that the stock market's down, because I'm going to buy the stock market. You have to understand that. Prices are down. Great. So I'm going to buy them. I buy low. Okay. Remember, retail traders sell low. Institutional investors buy low. So I'm just waiting for the right time and the right price. But my bigger concern is the yield on the 10-year T-note, and that's the tricky bit. Okay, so the Japanese stock market has found support. If this continues up, and see it's above the predictive moving average, If this continues up, that should bring Japanese yen weakness, which is right as rain. Hong Kong is forming a double bottom, but doesn't look great. Germany's getting crushed, but it should be. That makes sense. And remember, now something is different than before. Europe is not raising interest rates because GDP is zero, and guess what? Productivity in Germany is zero. So is it double topping? Yeah. Yep. So yeah, that would probably lead to a sell. Okay. The UK cannot raise interest rates anymore because their productivity is at zero. Would you sell it off the top and bring it back to the bottom of the range? Yeah. Yep. Yeah. Yep. Yeah. What else would you do? Let me add a little more time to there. Right? Okay. Australian stock market, they're importing more than they export, and they're an exporting country. They're in terrible shape. Probably has to do with that data that Dan's looking at, data from China. So anyways, this is what that pattern shows us. Okay, this sell zone predicts this target. Okay? How many people want a course on trading stocks? How many people want to know how to trade the stock market? Okay, I am putting together a plan. I've been writing it down, and boy, it's complicated. If you want to do it right, it's complicated. And the trick I'm having is I don't want it to be too simple. And I don't want it to be too complicated. So the research I've been doing is either crazy math or crazy simplistic kindergarten blue crayon type stuff. So I'm forced to kind of do the complicated side, but break it down into common sense. And that's a difficult task. And I remember that's why I decided not to get a PhD in economics, is that the more you do, the more it becomes math and it kills all the love. I love economics. So now I don't want to give you the simple version. I want to give you a very comprehensive course, very comprehensive, but something that breaks down, you're like, yeah, well, that's total common sense. So, like I've taught you a million times where, we calculate variance, right? And then you take the square root of the variance to get standard deviation, right? Now, this is actually applicable in a stock trading course, and not for trend trading. But I want you to be able to choose 3 companies. Have 3 different companies that we're analyzing. You see, we're going to analyze 3 different companies. Company A, B, and C. And we want to look at the back data and see how do they do in a bullish market historically, how have they done in a flat market historically, And how do they do in a bearish market historically? So just imagine one was AT&T, one was IBM, and the other one was Coca-Cola or something, right? And let's say we do some basic math to calculate the expected value. Because you want to look at how do they do in a bullish market. So you compare all three bullish markets, bearish markets, flat markets, and then you can, from all that, which is just probabilities, I don't know if you've ever studied probabilities, but when you do probability analysis, you can come out with a number. And you might find, what I'm hoping to be able to do is, let's say, all three companies you would expect to make a return or a price or whatever, depending on how I set it up, of 16. So which one do you invest? Well, see, this is where variance and standard deviation come in. And I've shown you how to do that in technical analysis, but I haven't shown you how to do it in fundamental analysis. So I'm designing these. So like one slide might take me 5 to 10 hours to design for you. I know, I'm slow. But I want you to be able to then take this data and we do our calculations and we have the same expected value, but I want you to find the one that's best to invest. And so now we have to do variance and standard deviation, and you might find B is the best one to invest in, even though it has the same expected returns as the other three. You want also the least amount of risk. Does this sound like the course that you're thinking about? Is this the type of analysis you'd like to be able to do? Because the other thing is, when I bring this back, there will be times when you might want the lower standard deviation. So now we're talking about portfolio construction. And you're like, if we're going into a bearish market, you might want lower standard deviation. But then when things are good, you might decide, and this is a management decision, that you want the higher variance. You want the higher volatility. So now, why would you want that? So now I have to explain or train, I have to train you on the difference between a Sharpe ratio and a Sortino ratio. And so that you can make the distinction of those and say, in scenarios here, you'll take the Sharpe, and on the scenarios like this, you'll take the Sortino. So you'll flip from a low standard deviation and accept the variance. Now, does that sound like a simple course? Like, it's going in the right direction, isn't it? But I'm leaning on starting where we cover the entire financial markets first. So I want to talk about hedge funds and investment banks and commercial banks and mutual funds. I want to talk about bonds so that you understand some bonds and treasuries, not just stocks, so that we could lead up to calculating best investments, if you will. Yeah, am I heading in the right direction, or you don't care? If you had something else in mind, let me know. The thing is, I don't want to do the mathy version. That's just crazy math. I want you to look at it and go, oh yeah, well, I'll take the one with the lower standard deviation, obviously. That's where I want to get. So that, here's the thing, when you're going through a stock screener, right? And you come up in a stock that you might be interested in. And then I want you to be able to look at it and go, oh God, look at that standard deviation. Pass. Just like that. Look at the Sharpe ratio on that. If it's a fund, you're like thumbs down. Okay? Too much risk or not enough reward relative to the risk. Or you look at like I said, the standard deviation, and you're burning through companies. Like maybe you got some sort of stock screener, and one of the things you'd now look at is the standard deviation. You're like, no, pass, no, pass, no, pass. Ooh, look at this one. And then you look at it again. Ooh, okay, cool. That one stock might look the same on the surface, but then you understand with that standard deviation what it's telling you and why it's more or less risky than just, do you think the stock price is going to go up? Really? Well, what's the distribution of possibilities, right? So I'm going to avoid the mathy stuff and get to the common sense stuff, because then you can say, well, what's the distribution, and what are the tails on this, and what's the ketosis, and all this kind of stuff. You're like, no. And there's lots of math that starts with like things that look like this. Okay, and you're like, no. Okay, none of that. So we'll just try to keep it common sense, but that makes it difficult for me. Okay. No, well, not some people are responding, so thank you for that, but most of you are not responding, so I'm worried that you don't even care. But I'm going to do this course anyways. But imagine the task for me, which I actually love. I just hope I have enough time to take this, okay? This is what I'm talking about. Take this, and I'm going to make this common sense and easy. And you're going to go, oh yeah, look at that. Yeah, the lower standard deviation's the better one, Wayne. Okay? That's it. Won't that be fun? I think that'll be fun. So I guess we'll leave it at that, because I got to go work on that now. The stock market's going to open in 30 minutes. There's lots to do. I got my fat coat on. I've lost 50 pounds. Like, dude, nothing fits me anymore. But anywho, it's a great week. I expect bearishness that'll bring prices down, and I'm going to buy it. Awesome. So, like I say all the time, and I mean it, peace on earth, may the pips be with you, may your profits be above average. And I will see you when I see you.